Well, it looks like we recently got confirmation that the Federal Reserve will be moving forward with rate cuts. If you take a look at the comments he recently made at Jackson Hole, we can see interest rates will be coming down very soon. So what should you expect? And what will rate cuts mean for the markets, for the economy, and for your livelihood? If you don't know who I am, my name is Joe Brown. I'm a former stockbroker turned YouTuber. I spent years advising the top 1% on how to manage their wealth, and now I turn my attention to teaching regular people financial techniques that exist outside the mainstream, things you'd never hear from a stockbroker or a financial advisor. One of the reasons I made this career change is because when I was a stockbroker, I was very curious about the way the markets worked and the economy worked. And I realized that nobody inside the belly of the beast has any idea how economics really works. I remember talking to somebody, asking them what causes booms and what causes busts, and the answer got chalked up to animal spirits. And this is a person who's on CNBC. This is a person who is very well known in giving their opinions and ideas on the economy and the stock market. So I spent the next few years learning for myself and researching and reading how the economy actually works. And I learned that if you have a fair understanding of how the economy actually works, then you have a fair idea of what monetary policy changes like interest rate cuts will actually do to the economy. So first, let's turn our attention to this chart, which is the federal funds effective rate. This goes back to 1955. You can see that from the 40s through about 1980, the Federal Reserve was raising interest rates. Yes, there were certain periods of time where they were cutting interest rates, but for that overall long-term period, interest rates were on the rise. After they peaked in 1980, for the next 40 years until 2020, interest rates were being cut. Yes, there were certain periods of time where interest rates were going up, but over the long term, they were going down. If history is any guide, then we are in a period of time that will look much more similar to the 40s through the 80s rather than the 80s through 2020. In other words, higher for longer interest rates, even if there are short-term periods with rate cuts. That's exactly what I expect we are experiencing right now. A short-term period of time where the Federal Reserve will be cutting interest rates. Ultimately, that will fuel so much more inflation that the Federal Reserve will have to raise interest rates yet again, just like they did over and over through 1940 through 1980. The second thing I'd like to point your attention to on this chart is the gray bars. Every gray bar that you see is a recession. And what you will notice is every single recession is either preceded by or happens during a Federal Reserve rate cut period. It happened in 1957, 1960, 1970, 1974, 1980, 1981, 1990, 2001, 2008, and 2020. If history is any guide, when the Federal Reserve begins cutting rates here soon, it will mark the beginning of another recession. Now, there's a caveat to this. If you notice on the chart, there are a few times where the Federal Reserve cut rates and it did not result in a recession. 1966 is an example, and so is 1984. Outside of that, all major periods of interest rate cuts by the Fed, whether it's in a long-term uptrend or a long-term downtrend, were associated with recessions. That brings up the question, is there anything else going on in the economy right now that would lead us to believe we are on the verge of a recession? And I would say that employment is a pretty big giveaway. The jobs numbers over the last year were not amazing. However, even with the not so stellar jobs numbers, the government just revised down over 800,000 jobs from its prior reports. Add on top of this the fact that all of the jobs that were created over the past year to 2 years, the vast majority of them were government jobs and part-time jobs, with people working multiple jobs to make up those job growth numbers. This means that overall, people have had fewer full-time jobs with fewer benefits, worse pay, more part-time jobs, multiple jobs in order to make up for that, just because they're trying to keep up with the cost of living. It's not a sign of economic strength, but a sign of economic weakness. And now we're finding out that a lot of those jobs that were created actually weren't. So it looks like the Fed cutting rates is not going to be great for the economy if history is any guide. But what is it going to do for the stock market? Well, later this week, I'm going to have a much more in-depth video come out on this topic. But right now, rate cuts are putting the stock market in an overall precarious position because of the yen carry trade unwinding. Right now, it is nowhere near done. And with the Federal Reserve cutting rates, while the Bank of Japan is tightening, it's going to force a lot of that money out of that trade, which means that as they get blown up, they have to sell what they can, not what they want to cover their losses, which is the same thing that contributed to the flash crash earlier this month, which means that it could very likely happen again. Now, I'm not positioned short, but I am prepared. Okay, so what will Fed rate cuts do to prices? Well, very simply, it will add fuel to the fire of inflation. Many people have been talking about recently how we've got the best inflation numbers in years, but inflation is not prices. Inflation is the rate at which prices change. And so yes, the rate of inflation has come down for most things, but that means prices are still going up after a few years that they were going up extremely rapidly, which means many people are still struggling to keep up with the cost of living. Yes, prices are going up more slowly than they used to, but they're still going up. And when the Fed cuts interest rates, that's going to make it easier to get your hands on new money for things like personal loans, auto loans, mortgages, and for corporations to get their hands on new money. And most importantly, for the government to get their hands on new money. We'll get to that in a moment, but all of this access to new money, because money is loaned into existence. So when it's easier to get your hands on loans, that's more money coming into the system. That is money printing through the banking system. It means more money chasing the same amount of goods and services, all else being equal, prices get pushed higher. Now, we know that the federal government is in a precarious situation with its finances. Every time it tries to borrow with 10-year, 20-year, 30-year treasuries, the auctions don't go very well. So they're forced to borrow at the short end of the curve, meaning they're borrowing for like 1 year or 2 years at a time, because that's the only way that they can borrow money right now without risking a failed auction. Which means if we see the Federal Reserve lower interest rates, it means that the government can now borrow at that short-term debt at a much cheaper rate than they are borrowing right now. That's great for the government, who it will be helped out by the money printer for their finances. But it also means that all those government deficits, all that money that they're spending, is more so going to be new money coming into the economy, which again, pushes up prices. And when prices go up, interest rates, here's the key that nobody's expecting here, for everything else and everybody else will go up. I do expect there will be a short-term period of time where auto loans, credit card loans, mortgages get a little bit cheaper. But when inflation rears its ugly head again, all that private debt, all those lenders will realize, hey, I don't want to lend my money out and have inflation eat away my purchasing power before I can get it back. Therefore, I'm going to have to charge a higher interest rate in order to just protect my purchasing power. So while the government will be able to borrow at cheaper rates from the Fed cutting rates, you and me will not be able to. Now, you might be wondering, if the government is borrowing money at a rate that is less than the rate of inflation, who's going to lend to the government? And the answer is the Federal Reserve and banks. This is a chart of the Federal Reserve's balance sheet where they hold all of the US treasuries that they have purchased from the open market. You can see that over the last couple of years, they've been doing QT, or quantitative tightening, which means they've been letting the size of their balance sheet decline. However, if you zoom in on the end here, you can see that the speed at which it's been declining has been slowing down. If we look at this chart in another way, we're looking at the rate of change in dollars. So anytime the blue line is above the black line, that means the Federal Reserve's balance sheet is growing. Whenever the blue line is below the black line, it means that the Federal Reserve's balance sheet is shrinking. We can see, yes, the balance sheet is still shrinking. However, the pace at which it is shrinking is itself shrinking. Said another way, the federal government will be borrowing at a rate that is less than the rate of inflation. In other words, negative real rates. And that will largely be financed by the Federal Reserve, who will no longer be doing quantitative tightening. At the very least, they're going to just keep their balance sheet steady, which means they roll all that debt over, or they'll start a QE again and start raising their balance sheet again. In conclusion, we are going to have a short-term period of time with lower rates. There is a window of opportunity where some people may be able to refinance their personal loans or their credit cards or their mortgage for slightly lower rates. It's not going to last. It will add fuel to the inflation fire, and the only person or people or group who are going to be able to continue borrowing at a rate less than inflation will be the government, and rates for everybody else are going to keep on going up. We are likely to see a recession ahead of us as well, which means you should keep your leverage small, keep your dry powder dry. Your number one financial priority should be increasing your income, and keep a good portion of your portfolio in inflation protected assets. And finally, if you're looking for somebody to walk you through exactly what is coming up next for America and what you can do about it, I've recently launched a brand new newsletter called Letters from a Heretic, and people are loving it. It's the only place where I'm going to go deeper into topics that I seriously doubt you're going to hear about anywhere else. As soon as you sign up, you get my 5-day series called The Most Dangerous Ideas in America. These are ideas that are so powerful they could soon reshape the economic landscape in America. We talk about things like the real reason that we might be on the cusp of World War III, the rise of the House of Saud, the true location of the digital financial all-seeing eye, a secret manuscript that predicted the end of America and what that means for your wealth, and even the US dollar's final phase. If you're interested in receiving that and starting to make better decisions about how to grow and protect your wealth during times of economic crisis, it's completely free. Just hit the link in the description below, enter your email. I'll start showing you everything I know. As always, thank you so much for watching. Have a great day.